Welcome to our channel. Now, we live in an age where finance seems like a mystery only understood by a few. From complex cryptocurrencies to fluctuating markets, it can feel like deciphering a cryptic code. But what if I told you that at its core, finance is built on simple principles? Principles that anyone can grasp with a bit of clarity. Most people know that investing is one of the most powerful ways to build wealth. But here's the truth. Very few people actually understand how it works. So, let's break it down. What exactly is investing? At its core, investing means putting your money to work instead of spending it all today. You're redirecting resources now so they can create even greater benefits in the future. In simple terms, you use your money to make more money. And here, something important. Almost every wealthy person you know, from Warren Buffett to Elon Musk, has built their fortune through smart investments. Not lottery tickets, not shortcuts. Investing. But investing can seem complicated. New terms, new platforms, new risks. It's enough to make anyone's head spin. So let's unravel it. What are the main types of investments and how do they work? First, stocks. Most of us have heard about stocks. But what exactly are they? Imagine owning a piece of your favorite pizza shop. That's exactly what you're doing when you buy a stock. A stock represents a share of ownership in a company. When you buy stock, you become a part owner of that business. But wait, how does buying a little piece of a pizza shop make you money? Well, there are two main ways. First, dividends. Think of dividends as a reward for being a shareholder. When a company makes a profit, it often shares a portion of that profit with its shareholders. These payments happen a few times a year. The second way is capital gains. Let's say you bought your pizza shop stock for $10 per share and then sold it for $15 per share. The difference, $5, is your capital gain. Of course, if you sold it for less, you would have a capital loss. So there are ups and downs, but that's what makes stocks both exciting and risky. Their prices can go up or down quickly. That's why you often hear stories of people making or losing a lot of money in the stock market. But here's the twist. That high risk can also mean high reward. If you buy a stock in a company that performs well, your investment can grow significantly. And where does all of this trading happen? On a stock exchange. A marketplace where buyers and sellers come together to trade stocks. Today, you don't need a Wall Street broker shouting on the phone. Anyone can buy and sell stocks right from their smartphone through brokerage apps. Next, let's talk about bonds. Have you ever lent money to a friend? Maybe you trusted them with some cash to buy concert tickets. In essence, that's what buying a bond is all about. A bond is like an IOU. You lend money to a company or government, and in return, they promise to pay you back with interest after a certain time. For example, let's say you buy a bond issued by a big tech company. You're essentially giving them $1,000, and they promise to pay you back $1,050 in 5 years. The extra $50 is the interest for lending them your money. Now, why would you do this instead of just keeping your money in a bank? Well, bonds are usually considered less risky than stocks. They offer a fixed return. You know how much interest you'll earn? And if the company or government that issued the bond doesn't have any problems, you'll get your initial investment back at the end of the bond term. That said, the returns on bonds are usually lower compared to stocks. But remember, lower risk often means lower reward. Here's a quick breakdown of the key parts of a bond. The coupon rate, which is the interest rate the bond pays you, the maturity date, which is when you'll get your money back, and the par value, which is the original amount you loaned. That's why bonds are often called fixed income investments. They give steady, predictable returns. Now, you might be wondering, where can I buy these things called bonds? Bonds are a staple in most investment portfolios, but you don't need to own one directly. You can find them within mutual funds or ETFs, which we'll talk about next. Mutual funds and Now, imagine having a bunch of friends who love investing in stocks and bonds, but you don't want to do it alone. That's where mutual funds come in. With a mutual fund, you pool your money with other investors, and a professional fund manager uses that money to buy a mix of stocks, bonds, and other investments. Think of it like having a pizza, a salad, and a piece of cake. A mutual fund gives you a slice of each. In the case of a pension fund, which is a type of mutual fund, you contribute to everyone's pool, and the money is invested for your retirement. So, instead of buying individual stocks or bonds, you own a tiny part of the entire collection. As for ETFs, exchange-traded funds, they work similarly to mutual funds, but they trade on the stock market like individual stocks. Both mutual funds and ETFs offer diversification, meaning you spread your investment across different assets, lowering your risk. So, here's the deal. Investments are like seeds. You plant them, invest, and over time they grow. Just like plants need sunlight and water, your investments need nurturing. That's where financial systems come in. They're the soil and fertilizer that help your investments grow. Let me explain. To invest, you need a financial system. Basically a network that connects savers like you and me with borrowers who need money. Now, where do you put your money to invest? Well, let's look at a few options. Banks. Banks take deposits from customers and pay them back with interest. They then lend that money to others like businesses or countries. Credit unions. Similar to banks, but they're member-owned and often focused on serving specific communities. Insurance companies. When you buy insurance, you pay a premium instead of cash. They invest that money and use it to cover claims when something unexpected happens. Investment banks. They help businesses raise money by selling stocks or bonds. Brokerage firms. They allow you to buy and sell investments like stocks and bonds. These entities are known as financial intermediaries. They gather money from savers and direct it to those who need it, helping investments grow. So, let's say you decide to invest in stocks and bonds. How do you keep track of it all? Enter investment accounts. Think of these as your digital wallet specifically for holding your investments. Some popular ones are margin accounts, used mainly for buying and selling stocks with borrowed money. Cash accounts, where you can deposit and withdraw funds as Lee, sometimes offering interest. Retirement accounts, designed to help you save for retirement with special tax benefits. Taxable accounts, your regular investment accounts. Remember, the money in these accounts is subject to taxes. And finally, let's touch upon two really important concepts. Diversification! Remember how we talked about spreading your investments across different types of assets like stocks, bonds, and mutual funds? Well, that's diversification. By not putting all your eggs in one basket, you would reduce the impact of any single investment performing poorly. The idea is to maximize your returns while minimizing your risk. It's like having multiple income streams or safety nets. So, if one investment doesn't go as planned, you have others to rely on. The second concept is time. Time is your most powerful ally in investing. The longer you invest, the more time your money has to grow. This is especially important for younger investors who can benefit from something called compound interest. Here's a simple example. Let's say you invest $1,000 at a 5% annual interest rate. Investing isn't just for the rich. It's a tool for everyone to build wealth. With the right knowledge and a bit of patience, you can turn your financial dreams into reality. Thanks for joining us on this journey to demystify finance. If you found this video helpful, don't forget to hit the like button and subscribe to our channel for more accessible finance tips.